Hello friends, this is Vijay Bhambwani. How are you doing out there? I hope my videos are helping you trade the markets better. Friends, since the last one fortnight, in my weekly videos, I have been warning you that the Nifty will take a little while to cross the 16,000 mount. And if you remember my last week's video's thumbnail, it was a little unpopular where the investor is lifting a very heavy load of banking stocks on his head, which was weighing him down. Probably that explains why the video received half the views that my weekly videos normally do. But hey, what's really more important out there is getting the markets right rather than play a popularity game. My intention in my channel is to put you ahead of the rat race using my in-house studies from my statistical model, the Barracuda, and now very soon to be commissioned, the IBEX, so that I can put my friends ahead. I don't mind sharing these in-house studies, which is what I do in these videos. And let's dive right into this week's video, seeing what happened out there. So, as the market roundup tells you, the Bank Nifty really underperformed the Nifty 50 by falling deeper than the Nifty. So, it's not really rocket science. My regular viewers will know why. Simply remember how the bond yields and the US dollar index have behaved, and you will be able to solve the mystery of what and why. Now, what you can basically see is, in spite of the Dixie falling, which should have been positive for the Indian markets because the dollar falling is always good for emerging markets, the markets have fallen. And old-time viewers will know that the USD INR, which is the United States dollar versus the Indian rupee, rose in spite of the fact that the Dixie fell. Now, the Dixie is a benchmark index of the US greenback, the US dollar versus the global basket of currencies, whereas the USD INR is typically only the dollar versus the Indian rupee. The Indian rupee has weakened against the dollar. And if you look at the bond yields, they are back to 6.20, which means that Indian bond prices have also fallen. Now, that has given a headache to the banks for their mark-to-market losses on their bond portfolios. Let's basically also see, now this headache of the banks on their mark-to-market portfolio is something that a whole lot of other experts are missing out in the market, and therefore you're not getting this kind of data, this kind of inputs elsewhere. So keep sticking around with me. I also have a very important update for you in the market at the fag end of this video. And that's not something that you really want to miss out because it's actually weighing on the top of my head since the last few days. Now, bullion rose along with oil prices due to a weak dollar because the dollar is the invoicing currency in the global commodity markets, and when the dollar falls, commodity prices rise and vice versa. So, rising oil prices have created a worry of rising inflation because oil and gas are multiplier inflationary commodities. If oil and gas prices go up, you basically see fruits, vegetable, milk, egg, all conveyance, taxi fare, etc. all go up. So that's not really very good news, which is also another factor that weighed on the market prices. Now, I've been warning my friends on social media for well over a year about inflation, and if you connect with me there, you can get day-and-day updates. My contact coordinates will come at the fag end of this video. Now let's take a look at the MWPL chart on your screen. This is market-wide position limits, the overall market open interest. Now this shows a routine fall after expiry on Thursday. And this MWPL will rise continuously till the third week of August, which is the precedents that we've seen so far. Traders tend to ramp up their exposure till the third week, and then in anticipation of a forthcoming expiry, they start to unwind. Now, coming up on your screen is the basis chart. Now, the basis is nothing but the premium enjoyed by the futures over cash. The basis also shows a rise on a week-on-week basis, which is also routine post-expiry, because the markets are giving the traders 4 full weeks to play around, and thereby the markets charge a higher premium in futures and options. After expiry, the markets charge a higher premium on futures and options, which is by the way, routine as a matter of precedence. Now, this premium gradually decays over time, and the fall in basis on Friday is noteworthy. It's basically sharper than what it should have been. Now, the selling pressure on Friday in the latter half of the session pressurized the basis. This is exactly why I keep advocating on my social media accounts that you should watch the last 60 minutes of trade on Friday extra carefully. Now, let's see the volumes chart of the cumulative August, September and October futures of indices and stock futures. This week saw selling at higher levels, which was accompanied by higher volumes. Now, part of the reason can also be expiry, wherein you square up your July futures and you initiate the same position in the August futures, which means the turnover gets logged twice. However, Friday's turnover was sharply lower, which needs careful monitoring. I want liquid markets where the turnover is high. Otherwise, your ingress and egress, which is entry and exit, will become labored, and the bid and offer spreads, the difference between the buyers and the sellers' prices, will widen up. That means your impact costs will go up and your profits will fall. Now let's take a look at another in-house study that you won't get anywhere else on the internet in the public domain. This is the impetus. The impetus is the momentum. You should not basically mix this up with statistical beta, which is pure price volatility. So, the momentum has nosedived very sharply, which means the velocity or the acceleration in the market has eased off. This is because the markets have become range bound and the intraday ranges have narrowed. So, in a way, this is good news because the sellers lack the steam to sell aggressively, but the bulls are not buying in bulk either. So, I would want the impetus to rise along with prices whenever the prices rise before I get the confidence to basically go out there and go long in big lots. Now let's turn to the most popular study, which measures the footprint or the exposure of various segments of the markets. Look at the FIIs. Their stock futures long positions are at a 20-period high, and their index futures too have risen on a week-on-week basis, which indicates guarded optimism. The DIIs, now this is extremely critical. The DIIs, on the other hand, have raised their stock futures shorts to a period high, which is indicated by a red line. And the DIIs now hold 12,26,147 lots short in stock futures. Their index futures shorts, which is indicated by a blue line, also have risen and are currently at 51,839 lots, which means the DIIs are very aggressive sellers in the markets. Let's take a look at what the prop traders are doing. Now, these are proprietary or self trades by the brokers, the specialists, and these guys are very well clued on as to who what the FIIs, the DIIs, etc. are buying, because these brokers are empaneled as registered brokers with all these entities. Now, these savvy people have cut their index futures longs to 8,242 lots, And the stock futures longs were mildly lower. I can give them a benefit of the doubt, possibly due to the expiry of the July futures series, which means the coming few days you need to watch what the prop traders are doing. Which means that the most savvy segment of the market, which is the prop traders, is now playing a cautious hand. Now let's come to the most interesting aspect of the market, the retail segment, because this segment is what has been pushing the markets higher so far. They've shown a certain degree of agility and open-mindedness by booking profits, although it's been a mild profit booking. And their stock futures net longs are at 9,78,953 lots. They are just a whisker short of the 1 million lots long position which they held earlier till maybe 8 or 10 trading sessions ago. And their index futures long positions have risen to 8,233 lots, which is actually neither here nor there. Now, let's come to the 10-year benchmark bond yields, which to me is a very critical area of the market. And this is something that rookies absolutely avoid, unfortunately. See, this market is the fountainhead of all money supply to the other asset classes. And this is something that the experts sorely miss. That's what's missing in the markets. Now, unless you understand the intricacies of the bond markets, you cannot hope to become a superior trader in the other asset classes. Now, last week, the RBI governor let a rabbit out of his hat by saying that the RBI is okay with rising coupon rates. Now, that took the Indian benchmark bond yields back to 6.20%, as you can see on your screen. And it's the upper end of the 3-month range. The result was instantaneous. The bank Nifty fell. Now, this is an aspect that I told you ample number of times to watch out for, and your feedback on my social media accounts and my direct messages have been very satisfactory. I'm glad it helped you understand how to trade the bank Nifty better. And I expect the 6.20% to be not challenged very fast, which means the yields can actually rise from here. And that will not just impact the banking stocks, but now it might spread to NBFC stocks. Now, very simply put, in my previous video, I had said that the RBI's coupon rate will raise the borrowing cost of banks, which will now have to give higher interest rates on their FDs because they'll have to match the RBI bond rates, and their borrowing costs will go up. Now, exactly the same thing is happening in NBFCs. Their fixed deposits that they borrow from, the NCDs that they issue, the non-convertible debentures and bonds that they issue will have to offer higher coupon rates, which means lower profitability for them. Are you really surprised why Bajaj Finance and Bajaj Finserv share prices behaved the way they did very recently? I don't think so. The savvy market players know what's happening and they made adjustments accordingly. If you've been watching Markets 360 Degrees with Vijay Bhambwani and his videos, you're ahead of the curve. And let no one convince you that benchmark bond yields do not impact stock prices, because you know better. Be careful who you're opening your mind to, because we as traders are brain warriors and we win and lose our battles in the market because of our ideas. So be very careful of whose ideas you're actually borrowing. Friends, let's now come to the US dollar index, which is a very critical aspect of the market. Again, that's sorely not given due importance, because the dollar determines how much is the imported inflation. Why imported inflation? Because 2/3 of all our imports are crude oil and natural gas, which I told you are multiplier commodities. Their prices can raise the prices of vegetables, fruits, milk, wheat, eggs, etc., etc. And the dollar price will determine what is the landed cost of these multiplier inflationary commodities. So if the dollar strengthens too much, your inflation actually quickens at a double the speed of a normal time. Now, the daily chart of the Dixie shows a fall on 4 out of 5 trading sessions, and the price is settling below its 25-day exponential moving average, which means the short-term trend is also under pressure. Note that the previous significant low or swing low is marked with a blue horizontal trend line at 91.50 mark, which I have been advocating as a support. On the flip side, the 93.5 is marked with a dashed trend line, which needs to be overcome on the upside before a meaningful rally can occur. Now, do remember that the dollar is very important to us because of the inflation that it triggers, and let no one tell you otherwise because you know better. The weekly chart on your screen shows that the price is just about holding on above its 25-week exponential moving average, which means the medium-term outlook is positive, but only for now. Dollar bulls will need a big boost because the US greenback is falling against the other European currencies. Last week, I advocated a range between 93.90 and 91.90, which was breached on the downside, because the intra-week low was 91.78. And the coming week may see an estimated, I stress upon the word estimated here, range between 93.25 on the upside and 91.10 on the downside. I would suggest you watch this Dixie fairly keenly in the coming days. Friends, let's now go to the indices, and let's start with the Bank Nifty, which fell on 4 out of 5 trading sessions last week, and it stayed below its 25-day exponential moving average, which you can see on your screen, which means that the short-term view is nervous. Now, that can of course change whenever the index trades sustainably above its 25-day exponential moving average, which is not really very far off. And the 34,000 round number is likely to prove to be a litmus test of strength of the bulls. And they must defend this level on all declines, otherwise the probability of a fall steps up. On the flip side, rallying up to fill up the open gap left near the 35,500 mark can force the bears to cover their shorts. Now let's look at the weekly chart on your screen. The price remains above the 25-week exponential moving average, which means that the medium-term outlook is positive only for now. The exponential moving average will provide support on declines, which will need watching. The widening triangle pattern marked by these two divergent trend lines tell us that the volatility will continue to rise higher on this index in the coming week. And in the week before last, this index was number 3, but it fell one notch to number 4, not because the volatility of the index fell, but because the volatility of the individual stock futures rose faster than the volatility of this index. And last week, I advocated a range between 36,450 and 33,625, which held perfectly well. The coming week is likely to see an estimated, I repeat the word estimated, range between 35,950 on the upside and 33,200 on the downside. Beta, which is volatility, continues to remain elevated, so I would suggest, my friends, that you trade on light exposure. Let's now go to the Nifty 50, which rose on 4 out of 5 trading sessions last week, and it ended with mild losses. It is much better poised in relative comparison with the Bank Nifty, as the structure of the chart itself shows. The price is above its 25-day exponential moving average, even though it's just about. And the dotted trend line above shows the index tends to go towards the 15,900 levels approximately, give or take a little, and then falls down. A clean and clear but forceful breakout upwards should end all the indecision and suspense. Till that breakout occurs, let's wait and watch. On the flip side, the 15,350 to 15,400 level is a support area to watch out for keenly in the coming week. Let's go to the weekly chart on your screen, which shows the price comfortably above the 25-week exponential moving average, which means that the medium-term outlook is positive, but for now. The blue trend lines show the narrow movement of the index since the last 7 weeks, and the breakout in either direction should be spectacular whenever that occurs. In the week before last, this index was number 20 on the most volatile list, but last week it fell to number 24 because stock futures volatility rose faster than the index futures volatility. Last week I advocated a range between 16,275 on the upside and 15,450 on the downside, which held perfectly well. And the coming week, the estimated, I repeat the word estimated, range between 16,175 on the upside and 15,350 on the downside. Beta here also is likely to stay elevated, so trade light in the coming week. My friends, do remember, I have a very important update for you at the fag end of this video, so don't go away. Let's now come to the most popular aspect of this video, wherein I give you 5 stocks which are high beta, high impetus, where you take small exposure, wait for large price moves, and 5 stocks which are low beta, low impetus, so you take big exposure, wait for small price moves. Hey, different traders, different mindsets and aptitudes and attitudes, therefore different strategies. So high beta, high impetus stocks where you take small exposure and wait for large price moves are led by Power Grid at number 1. Number 2, Dr. Reddy's. Number 3, APL Limited. Number 4, Lupin. Number 5, SAIL. So the low beta, low impetus stock list, when you take high exposure and wait for small price moves, is led by L&T at number 1. Number 2, ONGC. Number 3, Wipro. Number 4, LTTS. And number 5, Divi's Labs. Now, friends, for the important update. If you are watching this video on your laptop or your desktop, you will basically see the link above, wherein you can click on a previous video that I have made on who are wrong and the problem that China might provide to the world at a later date. Of course, this video was recorded a couple of months ago, but it remains ever valid. For those of you who are watching this video on your cell phone and the link up is not available, the same is provided in the description below this video. Now friends, in the last week or so, the Chinese market is becoming a pressure point for the emerging markets world and the investment universe out here. 2 of its very largest financial sector services companies, Evergrande and Who Are Wrong. Who Are Wrong, remember, is there in the video in the link, are in deep distress. As a matter of fact, Evergrande company's bonds are now trading well below 50% of its face value, and trades, if at all, are taking place in the private markets are very, very sporadic. The bondholders are extremely nervous, and there are rumors or fears rather of default of these companies. Now, whenever these companies go under, if at all they do, believe me, a lot of people and a huge amount of money will be lost by way of haircuts and write-offs. That can result in reducing allocation to the emerging markets universe, including India, and definitely Southeast Asian markets will get the jitters. Do note that the Hong Kong markets have given up all their gains of the year 2021, which means 7 months of gains are now lost. We are back to December 31st, 2020 levels where the Hong Kong market is concerned. Where Chinese stocks listed on the US markets are concerned, they've lost more than 75% of their value and counting. This can become a huge worry. China can become a problem for the global financial markets. It's early days yet, nothing is actually concrete, but the size of Evergrande and Huarong, which are multi-billion-dollar companies, is scary. And if they go under and the Chinese government does not support them, if it does not repay the bondholders and the creditors of these companies, even our markets will feel the heat. My friends, I request you to trade extremely carefully. Do not take too many chances with your money because volatility in the coming weeks will be extremely high. The money that we deploy in the markets as traders actually is trust money which belongs to our family and their future. Let's be careful out there. Friends, if you like this video, do subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment section, good, bad or ugly, I welcome your feedback. And help me reach out to fellow like-minded investors and traders by please referring my video to your family and friends. Also, my friends, is a hyperlink to Equity Masters YouTube channel wherein I put up 4 videos every week. Do subscribe to their channel, and there is a hyperlink in the description below the video to that channel. Also, the link to availing of a free trading guide from Equity Master. Do avail of this fantastic offer as well. I thank you for your patience, my friends, for being with me and watching my video. Vijay Bhambwani signing off for now till we meet again in my next video next week. My contact coordinates coming up here. Connect with me on social media. Have a very profitable week out there till we meet again in my next. Bye-bye for now.